What is going on, option traders, or hopefully soon to be option traders? My name is Bo Crable, the founder of Option Scout, and I have a very passionate video to talk about with you today. And it's about the risk versus reward for beginner investing people. You know, if you're looking to invest and you want to figure out what's the right strategy to do. Do I want to do day trading? Do I want to do dividend investing? Do I want to do ETF investing? Do I want to do options trading? Do I want to be an option seller? Do I want to be a crazy lunatic and do Forex? Okay, don't do the last part, all right? Let's just keep that out of the equation. I don't want to be talking about Forex on this stuff. Or do I want to do crypto? Okay, but crypto is just an asset class rather than a strategy. So I kind of want to go through each of these levels and explain something that I look at, which I personally believe that a lot of sophisticated investors look at this way of risk versus reward. And the best investment you can make is something that has no risk and an unlimited amount of returns. And those, and it's going to have an aggressive return. The worst investment you can make is something that has a low amount of return and super, super high risk. Well, let me give you an example, and I just don't advise people to do this, okay? There's a lot of, I had a mentor of mine refer me to this, but I invested into some fund thing that they bought retirement homes and they would pay you an interest, and it made 8%, okay? It's not that high. I might as well just buy the S&P 500. But so my max return is 8%. But then what happened is they had a bunch of issues, so now I'm not even getting anything. So I might end up losing majority of it. That's kind of the same thing when people that are getting staking on their crypto. It's okay, you're staking USDC. What are you going to do? Make 10%? At the risk of the company going bankrupt. But anyhow, let me stop talking about this. Let's start with day trading. The issue with day trading is it's generally a lot easier to lose money with day trading compared to, I'm going to put on another end of the spectrum, ETF index investing. So a lot of people talk about ETF index investing, how it's the best thing, greatest thing since sliced bread, all those things. And it is great. If you're not doing anything with investing into ETFs, indexes like S&P 500, the NASDAQ, the VTI, Vanguard funds, that is better than doing nothing. But the issue with it, a lot of those funds will underperform the S&P 500 even. If you look at a lot of these, these boring Vanguard funds, they're making 6% a year. Okay, S&P makes 8, 9, 10. So anyhow, that's the base level. If you look at day trading, a lot of people that are getting into day trading, they're getting into day trading because they want to make a lot of money and quick. I don't know why it is, but it's just it's kind of people that want to get rich quick scheme, they're kind of getting into day trading because it's you see these people posting huge numbers. And the reason why they're able to get those huge numbers is because they're trading really volatile stocks. Things that just go boom, boom. Okay, and the issue with things that go boom, boom is you can go boom, boom as well, and you lose a bunch of money. So that's an issue where you have the situation where if you're new to investing, and you start day trading, which what that is really meaning is you're trading stocks back and forth within a given day, which that aspect actually has churn associated with it, so you could be losing money just by the aspect of trading, because usually there's a cost to enter a trade. The bid-ask spread, if you buy and sell, that has a risk with it. But you're, first off, going into really high-risk assets that don't have a fundamental projection of actually getting a good return. And most people who are getting into day trading, they're not going off of the stock's fundamentals. They're just going off of this shows a weird triangle pattern, and I hope it's going to go to the moon. So that's super risky, and in many cases doesn't even have that much high of a return. People will spend $5 grand, 10 grand on a day trading course, and it's okay, you made 10 grand, but you had $100,000, you made 10%, and then now you have to factor in, you have to pay taxes on that, plus you had other commissions, things like that, and then you paid 5, 10K for a course. Okay, cool, you made 10 grand, you could have just bought an index fund. Okay, so then now let's talk about options trading. So options trading kind of can get a bad rap where it's oh, that's super, super risky. Well, yeah, if you're buying really low probability option contracts, then yeah, technically that is risky. That's the definition of risk. But on the flip side of it is selling options. And what I like to do personally is I like to hold stocks. I like to hold equities that I think have a decent chance of outbeating the market, and then I sell options onto that. So buying options is a risk-on approach, meaning that you are adding a bunch of risk to it. So higher return, higher risk. Day trading is definitely a risk-on situation. Actually, I don't even know if I want to call it that. But when you're selling an option, it's a risk-off. It depends what option you're selling. If you're selling a cash-secured put, that technically is a more bearish bet than just buying the stock if it's out of the money. Even if it is in the money. But and then a covered call technically is a more bearish bet than just owning the stock outright. However, there's levels to it. With a cash secured put, the further out of the money you go, so like my hand's off the screen now, the less chance you have of getting exercised, okay? For covered calls, the higher out of the money you have, the more potential of capital gains you're gonna get. So I like an approach, and then I'll kind of talk about just pure options trading as a whole, like you're not even owning any equity. I think that's a little bit crazy. So now you have a good mixture of you're owning stock, you're owning, and you could do this on ETFs as well. So you could be owning like indexes that you like, and then now you're adding another component to where you can get extra cash. So technically, if you sell options, you technically have a lower chance of losing money. So if you buy Apple stock and if you trade a covered call on it, you're technically less riskier than just owning stock as a whole. So for beginners, I love options trading. I think it's really, really great. If you do cash secured puts on the S&P 500, technically you have less risk than owning the S&P 500. So, and then the great thing I actually like about it, it's kind of the better of both worlds. This is why I'm so passionate about options trading, is you can actually get the best of both worlds. So you can have less risk and extra returns if you do it right. So, and that's for a different video. So now let's go into like stock picking. This is another thing where it's like, instead of owning ETFs, instead of owning indexes, I'm gonna pick the right stocks. The issue with this is, if you're a beginner, you're probably not a professional, and there's also a lot of like cognitive biases that are going on. You may be like, you know what, I really, really love Tesla, and Tesla has gone to the moon over the last few years, but that doesn't mean it's gonna be like that still. It could be. Or if you're like, you know what, I really, 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 really love Revolve stock because my girlfriend just loves shopping from there and she spends so much money there. Or maybe you're a girl and you love Ulta stock, whatever it may be. Guys can like Ulta stock as well. I'm just using examples. You may be like, I'm a huge fan of Nike. The issue with that is it's pretty hard to outperform. And a lot of the stocks that do outperform, you have a situation where it may not continue to do so. And then the next thing is you need to pick a lot of stocks to lower your risk. So if you go all deep into a couple stocks, if one of those stocks dramatically underperformed the market, you could have been really, really right on one of them and really, really wrong on another one. I like kind of Peter Lynch's approach, where it's you want to buy a bunch of stocks and you let your winners ride and you close out your losers. So you do research on a lot of stocks that you like, that you feel like have good fundamentals, have strong PE ratios, strong revenue growth, the financial of the company is great, there's movement behind it, the company's good, and you want to do as much of them as possible, like, buy 20, 30, 50 of them, which then you end up kind of being an ETF. And then, the ones that are losing, that are underperforming the market, then you probably should cut them off and add to your winners or something like that. So stock picking, it really depends how you do it. If you do it how most beginners do it, where if you're limited on cash and you only buy a handful of stocks, it's pretty risky. It's really a lot more riskier than owning ETFs. So that's why I like owning a lot of stocks and selling a lot of options on them, or just owning ETFs and selling options on the ETFs. So yeah, that's kind of it. The stock picking also kind of goes down to dividend investing. Like if you're like, you know what, I see AT&T has a really high dividend yield. Well, what if AT&T just underperforms the market? That's a huge issue. If you're going to get into dividend investing, you might as well own a bunch of dividend stocks. That's just because how the numbers play out. The more you have, it's a game of numbers, then your probability is going to be higher. So anyhow, that's about it. I will see you in the next video. Also, I'm coming out with a lot of free training at Option Scout. So I don't even know the link right now, but we're working on, my programs are working on this. We're coming out with some free training and some stuff. So if you want to learn more about options trading, check out the links down below.